12 different income methods that are used to help reduce that initial at risk, generate income on the position to where we maybe potentially can bulletproof the trade, meaning we have no risk to the downside, still have upside potential profit. It's a slower form of trading. You can use weekly options inside of it if it matches the techniques. But Mehdi had sent me a question saying that could you elaborate on one of the particular 12 different income methods, in particular income method number 7, on a position he has on BYD. Now, I don't know the exact numbers, but I have a general idea. Let's see here. So Mehdi says that he owns the January 2019 35 put, and it's at 520 and 550 right now. Of course, the stock's trading at about 33, was it? 32? 32, even. So he probably got into this at a different time, but his total cost basis into the trade, he told me, was about 38.50 or 38.60. Okay, so that's total stock plus put, and we're holding a 35 put, which tells you right now we're down a little bit on the position. Okay, so let's use some numbers here. I'm just going to use one contract. It's going to grab the midpoint for me, but I'll just put in 520 as a price here. And we're going to buy 100 shares of stock to make it the even, as we talked about, 38.60, put in a cost of 33.40. Okay. So this isn't too bad of a position. He's out to January. We've got a 9.3% at risk as well. Okay. There we go. Sorry. And a total risk of 360 roughly, or 9.3%. Now, Mehdi asked that one of the income methods, now that the stock's trading at 32, it's below the put strike price. And Mehdi probably feels the stock is stagnating or may recover. And he's considering income method number 7. Now, income method number 7 is really what it is. It's selling a put, but not against the married put. It's done if I get assigned, if I had a call open. So if I sold a call against this at, say, 35, and the stock had moved up to 36, and I didn't like the buyback cost, I may just let the stock get assigned at that short call and then sell a 35 or 36 put to try to get back into the position at a better price. Doing this in a negative format is not a good idea, okay? Why? Number one, if you just sell a put against it, it means that you think the stock has bottomed and that it's going to move back up, or it's going to be stable here between 32 and 33. So let's say I go out a month. I don't think I'd get a good premium in April. I'll take a look. Now, 31 put is about 50 or 60 cents. Okay, so if I sell the put now, in this scenario, it doesn't do me any good. I take a risk of 89.5%. Why? Because the long put I'm holding can only cover the stock itself. Whoops, there we go. The stock or the short put. It can't cover both. Okay, so now if the stock falls below 31, I'm losing on the long put and still losing on the stock, and the long put that I've purchased can only cover one or the other. What I don't want to do, if you think it's stabilized and it's going to move up, I don't want to sell the stock now because I'm going to take a $1.50, $1.60 loss. Okay, remember we got in at maybe 33.40, 33.50. If I sell to close it now at 32, I'm locking in about a $1.50 loss, and then trying to sell a put at a lower strike against this, hoping it'll expire. Well, that's dangerous because now you've just created a bearish position. Let me show you. Let's clear off the stock from our custom spread tool. And we take the $1.40 loss, which means I'd really have a cost basis of $6.60 on the put, and I'm selling an April 31 put against it. That's not a good idea at all. Okay? If you think that you're back in your position, let's take this back to 520, and add our stock back in. When you ask me the question, Mehdi, about should I be using income method number 7, that implies to me that you think the stock has stabilized and is going to move back up in price. In this scenario, if you think it's going to move back up in price, it's stabilized, I would try to see if there's an income method number 5 available. Or if you think it's going to move back up and you want to leave the upside open, I'd consider income method number 6. Rajiv posted a comment, is a Condor a better option, or using a Condor on top of the married put? There are 2 ways to do a Condor radioactively. This is not the time to do it, because any Condor you create on this scenario, to get a good premium, you're going to have to be using calls that are below the put strike price, below your put strike price, and puts that are down here. So you're going to be in a loss the entire area. It's not going to get you back to break even. You'll get a little bit of credit, but it's not going to be a good position if the stock rebounds up or rebounds down. Okay, you're still going to be at a loss because you're already underwater to begin with. That's not when you want to do the Condor. Even though, Rajiv, you think the stock is stable or is going to move back up, that's not the time to do the Condor now if the loss is already down. What you may want to consider doing is adjusting the put, income method number 9 or income method number 3, to reposition this, maybe lower the total cost basis, then evaluate another income method. But again, in this situation, a Condor wouldn't work. I mean, I can look at one, and I'll probably have to go out to May, but I've got to use the 35, and to keep a good premium, I have to use the 37. On the put side, I might use the 31 and the 29 if I do a full Condor. There's 2 different ways to do a Condor. The other way is actually better than what I'm showing here. Nope. But if I structured the call on top of it, could it work out if the stock stays between 31 and 35? Yeah, but because it's already below our cost basis, this isn't exactly a great idea. Okay? We've taken the risk up to 12.2% because the addition of the bull put credit spread. If we still think we're in a hesitant market or a declining market, you're still worried about downturn, I would not consider this at all, nor would I consider any structure of selling a put on top of it with the current market situation. Okay? Let me just take a look here on BYD. Now, earnings are coming up on 5/1. So we're still about a month away. It's unconfirmed, but it's going to be around that time. But it's still a month away. So that's good. It wouldn't, but I couldn't do the May series is where I was going. See, this May 18th series, I wouldn't do any type of income method 7. Any type of this income method with a Condor, with a broken wing butterfly on this structure out to May, because earnings are probably coming up in the 1st. I want something that's either going to give me the advantage to take advantage of if the stock swings too far down or too far up, or focus maybe on premium in April if anything can be generated. And again, the way the market's been, I'm very hesitant to do anything extra about selling a put on top of this because it takes on too much extra risk, or doing a bull put. If you think it's stable and it's going to move back up, see if you can get an income method number 5 or maybe an income method number 6 for a little bit of premium to leave the upside open in case the stock continues to move. But you don't want the income method number 6 open. No, you don't want the income method number 5 open to May as you're going into earnings, because you don't want to cap the upside and you don't want to just sell a call. You may want to consider moving the put one direction or the other, even closer in time, to reduce some of the at-risk now. That's a possibility. But the reason why you say you'd sell a put is because you think the stock has stabilized and is going to move back up. That's fine, but in a tenuous or tumultuous market, I'd be concerned about adding that extra risk on the position to the downside. Okay? All right. So that did not offer weekly options. Let's see here. Okay, before I get to Nick, your question about just using the weekly options there, you just made a broad suggestion about weekly options, which is fine, Nick, don't get me wrong. I'm going to handle Rajiv's question while we're here because it's a similar topic. Yeah, let's just take a look at SPY real quick. I'm just going to go to the quotes page for SPY, and we're going to go to the chart. Rajiv makes a comment about how can the married put be used in the current scenario every day, either market goes up or market goes down with the same force. Okay, so here we're looking at sort of a 3-month chart, but you can see in the last 8 or 9 days, drop down, pop up, 260 to 265, drop down to 260. 2 days later, up near 265, back down to 255, back up to 260, 265, back down to 260. Well, here's the trick. I'm trying not to time my trades. I'm trying not to overtrade my positions. You know, AMAT was swinging as one of the ones I'm in, and it's been swinging wildly, Rajiv. You could overplay it to death, okay, if you tried to. Now, in this one here, you see a good range of 265 to 260. I know what Sam would say. Sam was sharing emails with me earlier about his success on SPY today, buying puts and selling puts, but he said overall the best thing he's been doing is a strangle, where he's perhaps buying a call or buying a put when he's at a high, looking for a low to buy the call, taking the profit, moving it back down. And see, he's been doing it really well. He also watches the market more than I do. You know, during the day I might see, not every day, but once or twice a week I might see 5 or 6 emails from Sam, and the first 1 or 2 today actually came through before I sat down and looked at the market. And that's why I didn't answer you, Sam. I was actually not available this morning. I came in a little bit late. In any case, in a married put, I could try to follow. Let's look at AMAT over the same time frame. And on AMAT Applied Materials, I'm holding the stock with about a cost basis of $56. I've got the 60 put. I'm pretty much bulletproof on the trade. But see, it was up here at 60, and then it just dove. And it's diving down quickly. So I'm probably going to, I should have made an adjustment last week. I think I may have even said that on, not last Friday, but before, the week before. I said I might have made a change. I haven't yet because I think I'm waiting for bottom out. What does that mean? Looking at this chart and the way the MACD has been spiking down and moving down, as is the RSI, I think AMAT might drop down to 50. I don't know if it's going to go to 49, but it might go down to 50. It's been there before. It's been below 50 before. That was, I made some good profit here and then made some profit with income method number 5 on the way back up. But the thing is here, it's still declining. I'm waiting for it to bottom out. Okay, I'm waiting for this signal here and to see it come off of the Bollinger Band. What am I going to do then? Well, I might take my 60 put and move it down. So this would reduce my cost basis lower, but then I get 10 points less payout. But of course then, if the stock starts to move back up, I'm going to realize a profit faster than staying where I'm at 60. Okay, that's the idea. And I'd probably use, if I see it moving back up, I might use an additional income method number 5 or something along those lines to help me get back to break even faster. But you see the issue. On AMAT particularly, I could have driven myself crazy by rolling down the put here thinking I was the bottom, then rolling it down again. This is 4-day time period, 5-day time period, and then rolling down again. And that's over trading. And of course, sure, I rolled down, I could have sold a call, rolled down, sold a call, rolled down and sold a call. But then if it comes back up quickly, like my other stock did, then I get caught, lack of a better term, with my pants down, and I have to pay more to roll this call so I don't get assigned for a potential loss. So I don't want to overtrade it, and I don't want to overthink it. But when I see what's been in a decline, I'm okay holding this because it's only about a 0.3% maximum risk on the position. That's the other benefit. But I'm waiting to see this occur on AMAT before I do anything else. And actually, I think I'm going to run out of time. And I think that's a shorter one. I had mentioned another stock. Let me show you that one. And this is probably more along the lines of what you were talking about. I did make a mistake on this. We talked about it the other day. I was in IBKR with a cost of 67, and I had the 70 strike put originally. But got in back here, I think. In any case, the stock moved up. We adjusted the put, sold a call against it. We've got a really low risk on the position. I'm now holding the 75 put on the stock. Now here I should have considered something, but again, it hadn't bottomed out yet. It kind of did here. So what am I thinking now? I might be able to roll down to the 70, take about 380 to 390 off the total cost on the position, and if this starts to cross back over, so Monday that'd be a good place to roll down, but if this crosses back over, I can't do an income method number 5 with this one. It only has 5-point strike differences. I need it to be 2.5 really to do that, or single strikes or double strikes in a weekly. Okay, but an income method number 6 play would be good here, or once I maneuver the put, lower the cost basis by 380, now holding the 70 put. It's September, so if the stock starts to move back up, I'm going to be able to do some adjustments inside that, or heading to earnings, maybe even set up that straddle or strangle on the position. But you see here, this one had movement as well, similar to what we saw in SPY. We dropped down, and then boom, it came back up to 68. This was a fake out. I was thinking about rolling it down here, but then it dropped again, and dropped again, and then last 3 days, up, and then down today. Okay, to 69.11. It was up at 70.40 yesterday's close. So what am I talking about? Well, it's really dangerous here to say, okay, well, it popped down here, go out a month and only get 80 cents for the 70 call if I tried to force that out to April, and then all of a sudden yesterday panicking, probably having to buy it back for $1.90 to $1.80 when it went up to 70.45, and there's still 14 to 15 days left. Okay, and as I mentioned, sure, maybe an income method number 6 would be better, but this only offers 5-point strike difference. I'd want to do a 70.72 or 70.72 and a half, something along those lines. Here again too, you know, the stock had pulled back here. Was now a time to sell a put, as Mehdi was looking earlier when it dropped below the SMA 50 and looked like it had a crossover. Well, no, that was the worst time to do it. Okay? Would an income method, an iron, you know, doing one of the two, excuse me, radioactive condors worked in that scenario? No, I would have gotten hurt to the downside. Was it a good idea to do it here? No, I would have been hurt to the upside. Is it a good idea to do it now? No, I don't think so. Monday will bear out more information for me, okay? But that's why I try not to overtrade the position on this, okay? All right. Okay, so that's Rajiv. And then you follow up, Rajiv, with you tried to create a married put on Intel, but instead you entered as a diagonal to try to get in the stock at a cheaper price with the April 55 put and the September 55 put. Since then, Intel is continuing to go down. Is it still a good idea to convert the married put? Only if you think it's going to come back up. I mean, I haven't looked at Intel. I'm not going to, I can look at it real quick, but I'm not going to analyze the chart for you. But you're losing money. If it's a, I mean, you're in a horizontal spread. What am I doing? Sorry, folks. Here we go. Okay, see, this one is in a down pattern, and you're holding the 55. So you might be forced to buy shares of stock at 50. Oh, I'm sorry, be forced to buy shares of stock at the 55 strike, but you receive some premium, and you're holding the 55 put. If it continues down, though, I don't know if both trades are giving you the profit you want. In fact, you might, with that horizontal spread, you're probably at a point right now where you're taking a loss on the downside. This is why I don't use calendar spreads to enter, calendar put spreads to enter into a radioactive trade, because it sets you up the opposite direction. All right, so you sold a 55. I mean, that's the price it is now, but you probably got much different prices. Say September, doesn't matter. Build it real quick. 255. So instead of doing the married put where we bought the stock and bought the put, we're trying to get in at a cheaper price by selling the 55, but it wouldn't have been at 688. This would have been, let's call it $1 before the decline. This might have been 505 for the horizontal calendar spread. Yeah, see, that's why I don't like it. You can lose in both directions. Okay, you're at a loss now. Is it a good idea to convert to a married put with it at 48.59? Remember, your cost basis is going to be $55 for the stock minus the premium you paid for, you got for the put, only if you think it's going to come back up in price. If you think it's going to continue down, you may have to really look to move this whole position down, but then you're going to end up with a new diagonal spread or horizontal spread, which won't be at profitability. It'll be at less of a loss, but it won't be at profitability. Okay, that's the trade-off. All right. Now, that covered some radioactive trading topics. All right. And gonna get to Nick's question now, to just a review of weekly options. Now, as I mentioned, there's nothing different about weekly options opposed to normal options except for a shorter expiration time frame, a smaller premium, and they're released on a different day. Nick just mentioned that. He said, does the tool put in the new weekly options after the close on Thursdays? Absolutely. And not after the close. It should be the first data run Thursday morning at about 9:45, 9:50, it will have the furthest next cycle out available. Okay, so there should always be 5 cycles in most cases, 5 weekly cycles for most of the stocks. And there's about, I think it's 470 to 480 securities out of the 4,800 or so total optionable stocks that offer the weekly options. And now pretty much all of them offer that 5 series difference. You have 5 weeks in a row, including the standard expiration. You could actually look at 6 or 7. Speaking of which, let's just go to a call chain. We'll just go to covered call, and I'm going to go to the option chain, the call chain for INTC. Okay, I'll just use AMAT, Nick, for now. Okay, so AMAT offers weekly options, and here's the one that expired today. Of course, as I mentioned, I have a 61 call that I just didn't feel like buying back. I just let it expire naturally. But actually, let me go to INTC real quick. I think it'll be a cleaner looking chain for us. Yeah, not as many selections there. But one of the things I can do on the chain, on the trials, I can go back. All right, so I'm going to go back one day. I'm going to go back to April 4th. So it'll be Wednesday, Nick. Okay, so let's go back to April 4th on Wednesday. Why am I doing that? Let's take a look at our expiration cycles. We had the April 6th available, the April 13th, April 20th, the standard. Sorry, it's not going to let me do that. Sorry. All right, so the April 20th, the standard, 27th, 4th, 11th, 18th standard. Okay. Now, 1, 2, 3, 4, 5 flagged as weekly by the exchanges with 2 standard expiration cycles usually sandwiched between them. Okay. So, in that case, now there's the 7 cycles I was talking about, roughly 7 weeks in a row with 1 or 2 being standard depending on the situation. All right, now let's go forward a day, and this was done, of course, Nick, as you mentioned. The chain is shown at the end of day for the historical data. And on the 5th, we didn't see the next weekly available yet because it already has its full cycle. All right, and then let's go forward to today. Do we have the next cycle available? No. Okay, so we might not see, you're not going to see the the May 25th is there. It was already there. I'm sorry. My apologies. It was already there, wasn't it? It was there then. Let me go back to the 4th. I'm sorry, Nick. Yeah, okay, so that was added on Thursday, but that May 25th, my apologies, it was there. That May 25th series, Nick, was available on Thursday morning. Okay, so when the first data run came through, it was already in the cycle. Those would have been available Thursday morning. However, if you're using a search on power options for, let's say, covered calls, and you're doing weekly covered calls maybe, let's just go to the weekly there, picks of the day that Ernie put together. On Thursday morning, depending on your criteria, you might not have seen any of the options for the Fridays for that May 25th cycle. Why? Because if you're using a filter for open interest, remember open interest isn't calculated by the exchanges typically until the end of the day. So that first Thursday when that new series released, that is roughly 35 to 42 days out in time, there is no open interest. There won't be any open interest during the day. For new options, it's usually not released till the end of the day. The changes, so if you're using a filter for an open interest of greater than 0, greater than 5, greater than 100, on Thursday morning, that next newest cycle that's available won't appear. You'll have to take that open interest filter out. All right, now, as just a general rule, let's take a good standard stock here at a good price. Well, I'll stick with INTC. I'm going to create just a quick search for us on this. I'm going to tell the system to go all expirations for our options, but I'm only going to allow it, and INTC was at 48, I'm only going to allow it to go to 60 days out in time. So that include all the weeklies. Actually, let's go to 120. Okay, all expirations out to 120 days. And we know that INTC is right around, I think it was $48 per share, right? So what I'm going to do is tell the system that I just want to go one strike at the money. I don't want to be more than one strike in the money and no more than one strike out of the money. I may even limit that further. Okay, but what I'm going to do now is just tell the system, show me all the covered calls for INTC that are in that range. I'm probably going to restrict it further. So it's at 48.79. I want the 49. Okay, Nick, I'm going to do that. So let me just restrict this further. We're just going to go 1-to-1 out of the money. So that's just going to show us the 49. And what I really want to do is reverse this. Rather than sorting it by percent if unchanged, I'm going to sort it by percent if unchanged. I'm just going to reverse it. Okay, why am I doing this? Well, this is a covered call, okay? But let's take a look very quickly at what we're seeing. And we'll look at I'm going to look at bull put credit spreads as well. I'm going to try to narrow that down for us as well. But here we are with INTC at 48.79. Our April 13th 49 strike is selling for 90 cents. Now let's just ignore earnings. Let's ignore charts. Let's ignore everything else and just look at the static comparison. So here's a weekly position on INTC. 7-day out trade is roughly 90 cents time premium, 88-cent bid, midpoint 90 cents. This gives us a 1.8 downside protection and a 2.3% if assigned for 7 days. And of course a high annualized return at midpoint of about 121%. Now all of these are similar probabilities because we're looking all at the 49 strike. First off, in general, Nick, anything that I'm doing with weeklies, whether it's a bull put credit spread, a bear call credit spread, a covered call, a naked put, whatever, part of a collar maybe, I'm generally not selling it now. And I'm also not selling it on Thursday, okay, for the ones that expire 42 days out in time. But I might make my adjustments on Thursday, but normally I'm looking for my positions that I open for a weekly to either expire worthless on Friday or to be assigned. I've either closed it or adjusted it usually before Friday. Why am I saying that? It's because I typically will not open a new position with the weekly option until Monday. Two flips of a coin here, Nick. Whether I'm doing bull puts, whether I'm doing covered calls. Sam will comment on this too. He'll probably agree with me or disagree with me. We've talked about it before. But I'm not a fan of opening these positions on Friday because I just don't know what's going to happen over the weekend. I don't know who's going to open their mouth. I don't know who's going to say what. I don't know what country is going to fall into disarray across the pond or in other parts of the world. I just don't know. So I'd rather not take the chance. I'd rather not wake up on Monday and see the market down $500 or 500 points, excuse me, if I did a bull put credit spread or a covered call, especially Intel's a bad example. The way the tech's been makes me too nervous. Great premium makes me too nervous. Okay? Now, so I'll wait for Monday. And the picks of the day that we started off with initially for weekly or monthly, those are based on opening the positions on Monday following an expiration. Argument is that 2 days from now, on Monday when the market opens, I missed out on 2 days of time decay. Well, that's also assuming that the stock went above 49 and as close to being assigned as what I want, and that nothing increased implied volatility over the weekend to where this might actually have increased even though if the stock didn't move. But yes, I am not taking advantage of 2 days of time value decay by opening on Monday. But I'd rather see a more stable market and know where I am with the stock price. If this falls another $1.59 on Monday, I'm at a loss now. I've got to manage it right away without even being in the trade for a full trading day. Okay, so that's sort of my concern about the weekly options. I wait till Monday to open them. But what's the comparison? Well, the comparison is here for just the covered calls. 2.3% every 7 days is much better than 3.1% every 14 days if I went to the April 20th. It's a weekly now, but it's the standard expiration. But again, having almost a 3% downside protection in a tumultuous market, meaning the stock can fall 3% before I'm technically losing money on the position versus 1.8 might be a better gauge. And then again, going forward, you see, 21 days out in time, it's a 4.5, gaining about 1.4%, and then it really starts to tail off, doesn't it? And this is probably because the implied volatility, which I don't have select here, was probably because the implied volatility of these nearer term options. And also, I bet you earnings is probably coming up somewhere around the 21st. Why do I mention that? Look at the increase in return and premium for the first 3 weeks. And this isn't every stock. We'll take a look at another one in a moment. But we go from 90 to 128 from 7 to 14 days. Well, okay, it's 38 cents. But geez, that's 42% premium gain from 1 week to the next. We jump 0.8% in profit going up to that next level. The next one, we go up 1.4, right? We gain another 70 cents roughly from 2 weeks, 14 days to 3 weeks. But then it only moves up 0.3, 0.4, 0.1, 0.3. Why? Not even looking at it, I'm saying earnings are sometime before or during April 27th. Let's take a look. It's just a hunch, just based on the prices, but let's take a look. Or is this the one I already looked at and it's not till 5/1 and I totally am, oh, sorry, that's not what I wanted. Yeah, I wanted the stock research, my apologies, not the option research. Nope, 426, dead on, okay? So that's why we're seeing that good gain on the 1 week, 2 week, and 3 weeks through April 27th, but then it just falls off the world. There's only a gain of 0.3 or 0.4 or 0.5 instead of gaining 1.5 going out the next week to May 1st or whatever it was, May 4th, May 3rd, and so forth, okay? Because those first 3 series are all going to be driven, these are driven by earnings, okay? And, these are actually 2 probably good plays because they come out before the earnings. If you think the market is settled, if you think tech is settled, because as we saw before, just in the past 5 days, we've gone from 52 down to 48, and that's not a position you want to be in a covered call. Okay, you don't want that kind of loss on the position. Let me just quickly change something. I'll take this out. I'm going to look for something that does not have earnings between now and everything will, roughly. Let me change that to 60 like I promised. Let me go back to the fundamentals. I'm sorry, not between now and expiration. I'm just going to look for a stock that's try to isolate. I'm sorry, the stock of 25 to 65. Just to get an idea here. See if I can find one I like. Console's probably one, 29.35. Don't know EPR. Let's try console. Let's see if that has what we want. CIEX. So we'll just add that in. I don't know if it offers weekly options. I thought it did. It does not. Okay. But anyway, what I was looking for is just, oh, AMAT might be one actually, now that I think about it. I think that's after, so we might get a few weeks here. Okay, Rajiv, I'll take a look at that one if I don't get what I want. So this one's not as bad, but it does tail off too. But see the same kind of numbers here with the same volatility, but a higher time premium, 118. That's because tech has fallen. I'm trying to avoid tech really if possible. Planet Fitness is not a good one. All right. Rajiv says Oracle. All right, but let's get off of this for a minute. So what is the advantage of weekly options? Well, the advantage is you have shorter time, Nick, for the stock to move against you. You can still get a really good premium in most cases, especially now that volatility has spiked, and you always get a better annualized return going week by week. Okay. What I've found is that with other strategies, with covered calls, we've done really well with the weekly picks of the day. They have a really good 3-year return and even a really good first quarter return of 2018. for the weekly picks of the day that are available in the covered call, of course, there as well, and just in the main search. It also comes down to premium, which is why I was looking for something that doesn't have the earnings coming up. And what do I mean by that? Let's take a look at bull puts. And we're going to do the same thing I just did for bull put credit spreads. Not saying that you should be doing bull puts right now or it's a bullish market, but just as an example. So let me go to the search. I'm going to start off with my weekly bull put screen that I use for my account, but we're going to make some changes. Why? One of the interesting things I've found about the weekly bull puts and the weekly positions is that through extensive testing, when we set up the different searches and everything, this will eventually be the picks of the day, the weekly bull puts. I have the numbers on that. But what I found is that whether I was looking at a 1-year, 2-year, or 3-year cycle from 2015, even a quarterly cycle, which we did, going 2 weeks out in time on spreads that offer a good probability of greater than, say, 75 or 80%, going 14 days out in time always outperforms going 5 or 7 days out in time. Why? Let's take a look. It's really because when you're doing the spreads, weekly options are popular. My testing has found that doing the 5-day out spreads are actually worse. The sweet spot is going 10 to 14 days out in time, going to the 2-week out series when you open a new trade, not the 5 or 7. But let's do the same thing we did. We're going to do all expirations, 0 to, I'll go 120. I got to lower my net credit. We're going to take a net credit of at least 5, and I'm going to look for a probability that's, oh, sorry about that. That's not what I meant to do. That just went backwards for me. Let's try that again. I think I hit shift and something instead of what I wanted to do here. But again, 0 to 120. I might go less than that, but I'm going to go to a net credit of at least 0.05, and I'm going to look for a probability below of between 78 and 82. I'm going to keep the 2-point strike difference. Another interesting fact with spreads, Nick, all the testing I've done has found that the 1-point spreads or 50-cent spreads, those lower margin spreads, typically will have a losing track record using the exact same stock criteria, but putting the spread to be at least 2 points or higher. It's fascinating. And it's because when the stock does shift suddenly, you end up taking the full loss on the 50-cent spread or the 1-point spread faster than you take the full loss here. Okay, so percentage-wise, I may lose 100% on that 50-point spread faster than losing 100% on a 2-point spread. That same move on a 2-point spread might only be a 20 or 30% loss. Whereas on the 50-cent spread, it's a 100% loss, and the numbers, the percentages really start to work against you fast. But in any case, I'm going to leave the 2-point spread or greater, 3% out of the money, this random probability range, and again, as we did before, I'm just going to use INTC specifically. And it's sorting by probability. Okay, let's just see that, but I really want to set it up by range. Oops, okay. 5 cents is fine. Oh, my apologies. It's because of that. And I got to take this out. That's right. I forgot to take my fundamentals out. My apologies. That's why we didn't see anything. All right. So now I'm just looking at INTC. No other criteria. Fundamentals or technicals. Any spread that's 0 to 120 days out in time is in this range. So we're probably going to look at similar differences. Net credit of at least 5. Okay. Let's run that. Wow, there's only one. And it's 42 days out. Lower the 1. Actually, let me just put the out of the money at 0, I'm sorry, and the return of at least 0.5. Bid-ask spread. Oh, make sure I take out open interest too. Some of those might not have any open interest. Good. Okay, playing around here. Let's see if we can get some more in there. Wow. Still only one, huh? All right, I got to change the probability. Let's go 70 to 85. Try to keep it around 1 or 2 strikes out of the money. All right, I'm just going to use the spread chain a second. I'm sorry. I try to find multiple bull puts here to show an example. Let me just use the spread chain. That's going to be easier. So I'm going to use the other tool. I was hoping to find it there. Let's look at credit spreads for INTC. I'm going to use a spread width of 2, net credit of 5, out of the money range, probability range greater than 70 but less than 90. Okay. All right, so why am I showing this? Let's go to April 13th. There we go. Why am I showing this? Well, over here is your bull puts. There's a combination of a 44-46, okay? And for Intel, selling the 46, buying the 44 would give me a net credit of 15 cents, okay, on a 2-point margin, so that would be $1.85. Why am I bringing this up? A couple weeks ago, and I'm not saying this applies to you, Nick, and actually going out to April 27th, the 42.44 only has an 11-cent net credit, a little bit deeper, but has that probability we want, 88% and so forth. Why am I bringing this up? We had an investor beginning of January during our Friday discussion saying that I have $5,000 to invest, I want to trade bull put credit spreads, and I want to make 20% return with a 90% probability. Okay? Well, if that's possible, the search tool would find it. We didn't see a lot of search results coming up in the bull put, so I was focusing it on Intel. But here we see a position with an 88% probability, and that's fine. And it's a 2-point spread, or 185, which means for one contract, I'd have to put up $185. For 10 contracts, I'd have to put up $18.50. Okay? Why is this important? If I'm only getting a 15-cent net credit, if I do one contract, Nick, 1 week out, 15 cents, 85% probability, even if I go to the 45-47 bull put with a 77% probability above, the midpoint's only 25. Not saying you do one contract, but if you did one contract, 175 or 185, you're only getting 15 to 25 cents. You've lost that entirely to commissions. So you got to go higher. Let's say you go 10 contracts on the weekly bull put spread here at 15 cents, so you're getting $150, but you're also putting up $18.50 margin requirement, $2,000 or $18.50 depending on your broker. Why is that important? Because the whole portfolio was only $5,000. Okay, this spread represents, was that 35-42% of the total portfolio? Not quite 50, of course, not 2,500, but it's more like 42%. That is way too much to put in one position. By the way, why am I focusing on 10 and 150? Well, you get some commissions out, but the rate of return that he wanted is still not there, right? Even up here, it's at 14.3%. He wanted 20. He'd have to go here at 47.5, 45, 33 cents or $330. Okay, it would be a margin requirement, 170, 1,700 for 10 contracts, but that's still in that 40% range of the portfolio. If Intel continues what it's done, if it goes down another $1.59, where is he at? He's below the short put. He's not at full loss yet, but he's close. If that continues that trend, he takes 100% loss on this for what he was trying to do. He's at a 42% loss in his portfolio. Okay? Yeah, Intel's dropped about 6% so far, says Sam, and you're right. I'm not saying this is a bull put, but this is the same thing you see when you start looking at spreads, even if they have a high probability going 1 week out. To get the higher probability, 75 cents or more, you're looking at a premium of 25 cents, 15 cents. Oh, and by the way, and if you put this down to 1 cent, if you put that down to one strike, you're looking at 17 cents and 8 cents respectively. Okay, so now you've got to trade 10, 15, 20 contracts to make that premium worth anything. Now here, the 44.46, notice 2 weeks out in time. Well, here's the 1 week out. We saw a net credit of 15, but that same strike, selling the 46 put, buying the 44, for 14 days. Oh, this is 21 days. I'm sorry. Let's go 14 days out in time. The 44.46 is 24 cents. Not quite double, but that's a little bit better. It's a 13.6% return instead of an 8% return 1 week out with the same strikes. And we have a similar probability, 79.7. Okay, so maybe not as the same, but still in our range that we want. That's why I like going 2 weeks out. It's not double the premium, but this is a double-digit return compared to a single digit. The 45.47, 23% versus 14%. And the premium is 38 cents versus 25. Sure, commissions are still going to take hold of this, but I'm still doing 10 contracts. Yes, I'm out 2 weeks, but it's a little bit better than 15 cents. It's almost the same as the 45.47 with about the same probability, of course, as well. But the way it's been dropping, it's not a good trade. But in any case, when you're doing weekly options, what you have to factor in, Nick, is does the premium match what you want for a stock that you want? Sam, you just sent in, I apologize, you just sent in a long comment about a bull put spread, I think, on SPY or Tesla. I'm not sure, I missed it. But what I wanted to find out, Sam, is it accidentally deleted. I was hitting the trash button on the Rajiv comments I responded to, and Nick's first question, and yours came up in the cycle, and accidentally the trash button got clicked too. So I missed what you said about your bull put. Nick, one more thing I want to show you too. I'm not sure if you're trading spreads, but when you're trading spreads, you've got to pay attention to the strike difference and the premium. Let's take us down. We're going to keep these minimal values here, but I'm going to take my spread width down to 50 cents. I thought Intel offered 50 cents. We're going to find out. There we go. And you say, well, isn't it better, Mike, to take on a better risk? And you were looking at 2-point spreads, which you were seeing 13% returns and so forth, but isn't it better to use lower margin, go to the 0.5 cents, 50 cent strike differences? Okay, well, sure, you have a lower margin, but now you're talking 5 cents, 7 cents, 9 cents, 12 cents. Okay, but that's a huge return, 12 cents on a 50-point spread, but now the stock at 48.79 can only drop to 47. I actually can't even do that. If it goes to 47, you're taking 100% loss. That's where that lie of leverage starts to kick in. Doesn't matter if you use 50 cents, a 1-point spread, or a 2-point spread, where I'm fond of taking, and just my testing has shown me this works better over time, going to the 2-point spread opposed to the 1 or the 50 cent, or less than 1. But it still all comes down to the lie of leverage. You know, if I'm doing this to get at least 12 cents, yeah, that's a 31.6% return. I mean, this is a 16% return, but it's only 7 cents. How many contracts do you need to trade to make that worthwhile and not get taken out by commissions? That's 7 cents. All right, 10 contracts is $70. And then you're going to pay $15 to $20 in commissions perhaps. Maybe not that much, but it depends on your broker. But that's a third of the premium. Right? If I pay $20, got 70 cents, I'm looking at about a third to a fourth of the premium I received just paid to commissions. So to get that better, I got to go to 20 contracts? Now how much commissions are you paying? Or 25 contracts or 30? Now it starts to get risky. Okay? But again, it's a balance. It really is moneyness, return, probability. That's what we look for. And I found that the sweetest spot for me is in that area of going 2 weeks out. And Sam says, small account, rather buy calls and puts and follow the trend of the stock like he does. So Sam will swing back and forth with straddles or strangles, investing $500. And Sam, I'm sorry, I was looking at another comment. But Sam, you know my feeling on that. I would go further out because I don't like buying the weekly calls and puts. All right, so I'd still probably go 2 to 3 weeks out buying calls or puts, you know, sort of at the money there to try to catch the swing on it. But again, you've got to watch it more frequently than I do. Now, I know you do. I just don't. Or put your bells and whistles and alerts on it. Do it as well. Yeah, you're in 2 weeks as well with your long calls because we might have a stagnant week next week. I don't know who that benefits, if that benefits any of you that are online today. But we might see a stagnant week next week. It'd be a refreshing change of pace. Not guaranteeing it at all. I'm saying we could see it. And in which case, if I bought calls on Intel for the April 13th expiration and the market stagnates now and just plops, and Intel sits at $48.79, $48.90, $49, well, the call that I bought and the put that I bought aren't really doing me much favors. In fact, you'd probably see a lot of implied volatility and time decay just quickly eke out of it if we see 2 or 3 days of a stagnant market on Monday. So buy 2 weeks out, as Sam says, and what I like to do with my spreads too, so you have more time. Sam mentions a comment, and I don't know if it would apply to anyone who is doing it. They'd probably try it, but you're right, Sam, they probably wouldn't get approved to do it this way. But one problem with a $5,000 account in some brokerages is that the margin can only do 3-day trades in 5 days. Okay, so that's another problem there with trying to use a margin account with under $5,000 in that as well for that also, okay? And one other thing I was quickly going to do here is go back to covered call. Let's take, instead of the weekly picks of the day, which Ernie found performed the best, the search that he used over that 1 and 3 year period, and the first quarter looked pretty good too. I'm going to go into the search, and I'm just going to talk about something basic. And Nick says, you got to run, but that was very helpful. I'm glad that was very helpful for you for the discussion on weekly options there. But when I'm talking about a covered call, you know, AstraZeneca might be something to consider. It's very high premium. I don't know why. Probably has earnings coming up. But let's talk about going 8 days out. Let's talk about opening a weekly covered call. Now, Ernie's initial starting point was to look for, I'm going to clear the filters just to start out and go 8 days out. And, you know, he started out saying, what would I expect doing a 5-day or weekly covered call? It's like, well, I still want some downside protection, but I can't expect too much. I want at least 1% downside protection. And I'm probably expecting at least a 0.7, 0.5% return if assigned. Okay, now I didn't know if he wanted to be in the money or out of the money. He found going in the money long term was much better return-wise, even with the market we've seen in the past 2 years, because anytime you have one of those hiccups, you're not getting enough premium to do it. But yeah, let's put in some good volume and some good open interest. Why am I putting such limited things in this search? Just because now what I want to focus on is I would want to see a stock that had good average stock volume, at least 750,000 shares on average traded per day. And I probably want some volatility, but I don't want something that's up at, you know, 80% volatility or underlying stock volatility that fluctuates too rapidly. That's good, but that also means it has a chance to move against me. As a general rule, I'm probably definitely going to only want to look for stocks that are in an uptrend. And I may use the MACD, but I'm probably going to come back to that. Fundamentals, well, I don't know your account size, of course, and we were talking maybe about smaller accounts, but since I'm doing covered calls, I'm going to assume that I've got at least $20,000, maybe $25,000, but that still dictates that I'm probably not trading stocks above $120 or $130 per share. Okay, probably not even that high. I'm probably more in the 95, but let's keep it at 120 because I have to buy the stock. And I want a good, maybe mid to large cap stock. I know small caps have the higher premium, but they also have a better chance of swinging wildly against me. So I'm going to look for just a market cap of greater than 2,500, which forces it, it's measured in millions here, so that's going to force it to mid and large cap. I also want a stock that's shown good earnings, you know, good growth in earnings over the last year, at least 5% growth in earnings. And I might put in a static PE ratio, 0 to 70, 0 to 50. And as always, I'd probably avoid stocks that have an earnings date between now and expiration. Why am I going through this as a starting point? Well, just alone, mid to large cap, good volume, good PE ratio, relative PE ratio, good earnings per share growth on stocks in an uptrend. Yeah, Polte is one we see. But look, at the money position, 58 cents, 1.9% return. That's pretty good for 1 week out. You see names in here like Nike, 1.5%. Normally when I run this type of search, what I see, Nick, is for covered calls and things of that nature, for covered calls, higher quality stocks here, Valero, Kroger, shouldn't have a 1.3% return if assigned or 2.3% right at the money. Why does it? Because we've seen a lot of volatility. Normally, Kroger at 23.77, selling a 1 week out 24 call, I'd expect 18 cents, 15 cents like we see on CenturyLink here, not 28 cents. Okay, the CenturyLink one at 18 cents. It's still a 3% return if assigned, a 1.3% downside protection, but that's because of the increase in the VIX. In the market that you were seeing leading up to 2018, November, December, and even the first couple weeks, the VIX was down 15 to 16, not at 20. It was actually down 12 at one point in January, not up at 22 or 23. So these premiums were much lower. Now this is still a good annualized return if I can get it week by week. Lows normally, I'd expect to only see a 1 week out return at the money, be it 0.5% or so, 0.8%. That's why I started with a minimum of 0.7. You'd say, well, are there bigger companies? Why am I not seeing Kraft or maybe Johnson & Johnson or something along those lines? That's because they're not offering that 0.7% return. I limited it out. We could get bigger names. Watch this. I'm going to take the percent if assigned to be between 0.3 to 0.8 and a downside protection of at least only 0.4. Okay, so I'm restricting it. We won't see these companies. There are a lot of good companies in there. Altria, Starbucks, DR Hutton, Urban Outfitters, 0.8, 0.7, 0.6. Again, look at the premium. Well, these are slightly in the money in order to get that premium, of course. But the time value, 28 cents, 21 cents, 6 cents on Gold Corp. Where I'm getting at is, does that return match your goals? If you can get it consistently, that's good. But what about the premium? And if I bought 100 shares of Starbucks, yes, I'm selling an in-the-money call for $1.20, but I'm getting 41 cents a time premium for a 0.7% return. That's actually pretty good for a 1 week out, going slightly in the money. But again, does it match your trading goals? Okay. And if I only bought 100 shares, that's $41. What's my commissions? How much is that going to affect my return? That's what you have to consider with the weeklies that normally you'd reserve off of it for things like bull put spreads. But I still want to go 2 weeks out on the bull put spreads as well. But these are companies you might be looking for. Altria, Starbucks, Urban Outfitters, 0.7, 0.8% return. But now you've got to focus again, how much are my commissions affecting the time value of the trade, which is my true profit? Would this drop it down to 0.3? You know, if I did 100 shares and one call of this DHI covered call, yes, I'm getting 209 as the option bid. That's great. But the return is 28 cents. The time value, 0.6% return for that slightly in the money covered call. Now you have to talk about, if you paid $25 in commissions, is that trade even worth it? Probably not. We want to be back to the search we were on before. Yeah, Sam had shown me his returns. He had a good run for using his straddles and his puts. Excuse me, folks. With SPY today. But he said for a 2-hour period it seesawed, and he was just waiting for the next movement there. Let's go back and take a look, shall we? Change up a little bit. Going SPY, 1 day. Let's try 5 minute. Okay, so here's the here's the seesaw range. Okay, this was maybe sort of a no zone or a no trading zone at that time that Sam was in. So he started early in the morning here. Really sorry, folks. I'm gonna have to clear that out, aren't I? So what Sam was telling me, he says he's starting the run, and it was looking pretty good, and you can see why. You know, following the MACD down. This is where the seesaw is, isn't it? You see it twice. You see it on the MACD chart there where it was just doing nothing. Do a better one. I wish they had a little something extra here. They don't. But here's that seesaw time on the MACD, and also you can see it's just bouncing off the moving average there. It's not really giving us a trend. But in the beginning, you know, started off 265 or so, run down to about 262. That was good. But then Sam sent me an email that says, the party started. He saw the crossover he wanted. He told me the party started for the puts, and then he said, yep, got the party. And what was it, 3:10 you sent me the email, but you probably stopped it at 3, Sam. So he was just following sort of the MACD trend the whole day, and so when he saw that at about 3 o'clock when it bottomed out, and he saw the MACD trend got out of his puts there and let it run. And right now you're saying you've got a 255. Oh, wow, it's not even on there, but a 255, 250 bull put spread. So you sold the 250. Oh, I'm sorry, no, it is there. Sold the 255, bought the 250 bull put, and that's because you're trying to keep it away from, I know why you selected that, you're trying to keep it around the 250-day moving average. So was it, you did it when it was at 258. Okay, so you did it at the bottom here at 258 when you saw the MACD cross. That's when you entered the 255, 250. And bought calls for 260, looking to see what happens on Monday. Okay, that's good. That's good. So we'll have to see. But again, it's always, and I know you're protected in the sense, Sam, you're talking only about 5 contracts here on this one with the calls and the bull put, I guess. But again, what we're looking at going forward is that anything could happen over the weekend, but you probably made sure that wasn't only a maybe 1 to 2%. I'm sorry, that the bull put and the long calls are all probably less than 1 to 2% of your total portfolio. Can be profitable going in. But yeah, I use the MACD trend. You know, we talked about that earlier with the married puts and everything with the Intel position. I don't know if now would have been that time we saw an Intel with the MACD continuing down and below the signal line, if that's something I would consider selling a put on right now until I see the trend change directions. Now this is a daily, of course, but you know, even if I'm looking at opening a married put, if this was a 3-month chart and this was 4 or 5 days ago and I saw the MACD crossover and then the stock crossed the 20-day, this is something I might consider coming off of and looking promising for a long call, a collar, maybe a bull put spread, or a married put longer term. Okay, that's the trend I want. I'd like to see it above this. For example, I didn't open a position. I just saw it on one of the searches we ran, but I was talking with a gentleman yesterday, RadioActive Trader, subscriber of Fusion and owner of the Blueprint, and I was talking about opening the position on the ones that came up. There were only 3 or 4 yesterday that matched the search, and E-Trade wasn't looking good either, but well, let's just go back a day. I'm going to do the back test here for the married put screen for yesterday. And the default radioactive search sorted by earnings per share growth. There should only be 4 that come up. Oh, it's Fernando. I'm sorry, Fernando. It was during our, are you still online? It was during our coaching session yesterday afternoon. And I was talking with Fernando. And he's no longer online. He had logged off. He was on a little bit earlier, and we were talking about some of the married puts, but he had to log off too. There's a lot more I was seeing, but the ones I was looking at, 5 below, the Potle one was in there, PTLE, and oh, okay, I know why. Let me try April 4th. We had made changes to my limited, the stock price, so we weren't seeing ServiceNow and Grubhub. So what I had done is we had changed it to be no more than 8% at risk, and the fundamentals, I had taken this down to my range, about $85 per share. I think those were the only 2 changes that I had made on it. But I saw 5 below was one of the ones. Long story short, we were talking yesterday during the session, Fernando and I. I must have made another change, but we saw 5 below. We saw VIV in there. PTLE was on there too. Why am I going through this? Because I said if I was to open a position on the 4 or 5 that showed up when we made our changes, this one yesterday was the closest, 5 below. PLTE was pretty good too. Why? Because I had seen this bounce, the move up. I had seen the MACD increasing. It pulled back today, so I'm glad I didn't open it. And it had just come off the Bollinger Bands, and usually you see a condensing period and then it shoots back up. But I didn't open it, but this was one of the other ones. The other one was PLTE or PTLE. I can't remember which one. I think it was PLTE, Polte Corporation. Nope, that's not it. Let me try PTLE. Sorry. I'm going to have to search for the symbol real quick. Okay, so I just went to the symbol lookup. Maybe it was PULT. Oh, it's PHM. Okay, I'm sorry. That is the right one, but that's the Pulte Corp I was looking for. So PHM. I apologize, folks. Let's go back to that. Okay, so that's the one I was interested in. Why? Because, again, it just had that recent crossover. That's why I only saw the 4. I'm sorry. I'd put in, when I was on the phone with Fernando, we had put in a MACD that had to have crossed over within the last 5 days. And so that's what it was. This was the MACD cross. And it could have been related to earnings, but it looked pretty good. It had this condensing period, and the MACD started to turn, and it just moved up above the divergence line. Pulled back a little bit, but I told him I was probably going to open it today. Then I'm going to maybe consider it on Monday. We'll see it on Monday. That might be my new married put, because I liked that through all the market turmoil, it held where it was, and then it did have this pop, but I have to find out why. Was it because of earnings, or was it because of some other event that everyone was waiting for? But it did have a strong decline recently, you know, in the February oops cycle, but it stabilized well, and it was stood pretty well the March 20th and the March 20th fear, market trading fear and things that we were looking at, and then it popped up. But as far as a technical trend, that's the one I was looking at. It was PHM. I'm going to jot that down. But 5 below looked okay too until today. So let's go back here to the 5th. Let me go to the next one here. I'm sorry, and yeah, I'm on April 5th. Let's go to my radioactive default. Let's run that in. Make my 2 changes again to the risk factor and to the stock price, but now change it. I usually like, I think I was at 750 again, but that's okay. But I want the MACD. Actually, I'm going to change this. I'm going to go 0 to 6, 0 to 7, 0 to 6. Let's go 0 to 7. Oh, and 5 below. That's one of the reasons why. So that's probably too restrictive. Let me go back. But that is a screen. I'm sorry, I used the MACD. That the MACD has crossed the signal line 0 to 7 days. That's what I'll use when I'm looking for something that has recently crossed over, that I'm trying to catch the trend there of a recent trend. And I might watch it for a day or two. But there we go. There they are. These were the 4 that came up. And I thought Michael Kors was the weakest, and it had the biggest move today. But PHM is the one I was considering to, oh, I'm sorry, that was on April 5th. These are the ones that came up at the close of business. But ConocoPhillips, I'm not sold on oil yet. I'm not sold that oil is stabilized. And it dropped a little bit today, but look at that. What I look for, it crossed over. It was still strong and moving positive over the divergence. What I mean by that, the MACD line, of course, is the blue line here, and the black line is the divergence. So it had moved above, and it was increasing away from the red line, which is the EMA. RSI yesterday looked pretty good, but again, it turned today. But this was looking pretty good. But I'm not sold on oil as a whole. Too many things can happen geopolitically that can cause a problem with that. And so I looked at Michael Kors was the other one. And it had just moved above too. This had the strongest technical trend as far as the MACD and the Bollinger Band went. And this should have been the one. It closed down 116 today, but it was up at 171 yesterday. I really would have liked it. It did jump above and closed above. It had a Bollinger Band breakout. I'm going to watch this. Kors, just by the trend alone, is looking pretty good. And 5 below, we saw that too. So that's what I look for in those kind of charts. And the opposite with the bearish. And this one looked pretty good too, but it's just had that hesitation. Everything did, of course. But to be honest with you, if I open a new married put next week on Monday, I'm going to say Monday or Tuesday, maybe Tuesday during the live webinar for RadioActive Trade, I'm opening one. If things stabilize, it's probably going to be one of these 4 unless something new jumps in. And it's likely going to be 5 below. I'd really like to do Pulte because it's a lower cost. Is there an advantage or disadvantage to one? Yeah, there's an advantage. Pulte, oh no, there isn't. No, Pulte offers the weekly options. One of the 3 I was looking at the other day didn't. I'm sorry, it's not one of these 4, but one of them didn't. It only had standard. Oh, it was this one. That's the advantage. The advantage of Pulte over 5 below is that it offers weekly options. Whereas Chipotle only, I'm sorry, 5 below only offers standard, and guess what? Only offers 5 strike differences. Now that's good. At 72.53, the 75 call would look pretty good if I open this with a 75 put. But if the stock was at 70, I'm going to see no premium here. I have to wait for it to move. That's the situation I'm in, by the way, with Interactive Brokers right now in my actual portfolio, because the stock's below 7. It's right at 70. I have the 75 put, but there's no 72.5 strike. It's only standard expirations. So that's why I'm hesitant on 5 below. I like Chipotle a little bit better, and Michael Kors, which does offer weekly options if I'm not mistaken. Yep, we've got the weekly options there. So I might open both next week, Michael Kors and Chipotle. Those of you that are Fusion subscribers, you'll see when I get into those as well. And Sam says, he said that the, just for his trading, stocks that are under 50, calls or puts deep, you buy calls deep in the calls or puts deep in the money because they tend to move slowly, and stocks above 100 can be bought out of the money because they move faster. That's a good point. You tend to see more percentage movement, especially as you're using weekly options with $1, $2, $3 strikes out of the money. Or here even on this, you'll see these stocks tend to move faster and break 67 faster than Chipotle at $30 will break 32. It's percentage gain, but it's also monetary movement for where you're going and buying or selling as well. But it's a good point, buying the in-the-money calls on stocks under $50 versus buying the out-of-the-money on stocks over 100 because of the quickness of the movement. That's a good idea, Sam. I like it. All right, and thank you for the point, Sam, I should say as well. I don't see any other questions. We are at 5:50, so we've gone a little bit over. Oh, there we go. Just want to remind everyone, of course, if you haven't done so yet, you can go to poweropt.com at any time. Just put in your name and email address and start the 14-day free trial. And then this is actually incorrect. I apologize for that. But this the subscription levels after that. Oh, I'm showing the wrong screen again, aren't I? Yep, there we go. The subscription levels after that, the real time is actually 120 per month, and the historical is 160, I believe. But yeah, the 20-minute delayed is $60 per month after the 14-day free trial, and then with the historical data, that's $100. And we do offer an end-of-day service, which is actually only $40 per month, but the data is only updated at the end of the day. And of course, I just want to remind everyone as well, we'll have some presentations coming up next week. For those of you that didn't see it, if you go to the YouTube channel, I did post a video yesterday that was talking about long call comparisons versus the married put, how they're not parity trades. Even though the long call uses less capital, we looked at a portfolio side by side to see what could happen. As I mentioned, we'll have a webinar next week on Tuesday and possibly Wednesday, and you'll probably see another recording come out from us that will be posted to YouTube, Ernie's introduction to straddles videos for earnings plays. That'll be up on the site. Might already be up on the site, actually. That's what you can look forward to. But if you do have any questions over the weekend or going into the week, remember, send me an email at any time to support@poweropt.com. You can also call us during market hours at 302-992-7971. Well, ladies and gentlemen, thank you again for joining me for today's presentation. I hope your week wasn't that stressful with some of the moves. It's good to see Sam showing some profits. I had some good VIX calls the last 3 or 4 days, but I'm not closing them yet. Should have closed some of them, but I haven't closed them yet. I'm waiting to see what happens next week because they're further out in time towards the April standard expiration, April 18th instead of the one next week. But it should be good and interesting and fun. Good market hedge, the VIX calls. But you got to catch them at the right time because I bought them a couple weeks ago. Didn't buy them this last week because they're a little expensive. Sam, thank you for joining me. Thank you for your comments. I hope you have a great weekend and you get to spend time with your friends as well. Rhonda, you're welcome. I hope you enjoyed the presentation. Ladies and gentlemen, we take care. Have a fantastic weekend. Nice, relaxing weekend. We'll see you soon. Not 100% sure I'll be online on Friday next week. We'll see. But we will be back, of course, on the 20th for the expiration if we're not. But we'll see if we're going to be around Friday or not. Take care, everyone. We'll see you soon. Good night.